Why are Australian households so indebted? Because we've gone out there and bought houses, not built new houses.
The systemic policy failure is that government has withdrawn so far from housing as a policy priority.
Well, like the rest of the world, Australian birth rates are dropping and
Australia is drowning in debt. Household debt now stands at approximately 111.5% of the country's total economic output. For every $100 of disposable income, the average Australian household carries about $182 in debt. That's one of the highest private debt burdens in the world. And the biggest driver? Housing. Owning a home in Australia is now so expensive that 3 of its biggest cities, Sydney, Melbourne and Adelaide, rank among the top 10 least affordable housing markets in the world. Sydney, in particular, is the second most unaffordable city on the planet, behind only Hong Kong. In Adelaide, where the population is barely over 1.3 million and there's no major industry, housing is still considered impossibly unaffordable. This crisis is changing lives. People are taking on bigger mortgages, cutting back on spending, and working longer just to keep up with loan repayments. Some are choosing not to have children because they can't afford both a family and a home. Others are stuck in lifelong renting, watching homeownership slip further out of reach. And yet, for all this financial stress, government debt is comparatively tiny. Households are carrying the real burden, while policymakers keep pushing migration, allowing unchecked property speculation, and failing to build enough homes. So how did the country get here? Why is housing so unaffordable? And how is this level of debt affecting not just individual Australians, but the economy as a whole? Australia's private debt levels have reached record highs, far surpassing government debt. Average household debt in Australia increased by 7.3% in the 2021-22 financial year, reaching $261,492. Meanwhile, average household gross disposable income rose by 3.7% to $139,064. This indicates that household debt grew at a faster rate than disposable income, making Australian households some of the most indebted in the world. By contrast, government debt sits at just 43.8% of GDP, highlighting that individuals, not the state, bear the greater financial risk. Unlike governments, which can manage debt through monetary policy, taxation and currency control, households have far fewer options. Rising mortgage repayments, stagnant wage growth, and inflationary pressures mean many Australians are forced to spend a disproportionate amount of their income on housing. The financial burden continues to grow as homeowners struggle to balance mortgage payments with everyday expenses. In fact, housing affordability in Australia has deteriorated significantly. According to Demographia's 2024 Housing Affordability Report, Sydney, Melbourne and Adelaide rank among the top 10 least affordable cities globally. The situation in Adelaide is particularly concerning. With a population of just 1.379 million and lacking a major industry or tourism sector, it is still ranked as the 9th most unaffordable city in the world. This paradox is largely driven by excessive migration, property speculation, and constrained housing supply. With mortgage repayments consuming a larger share of household income, financial strain is increasing. Rising housing costs mean less money for discretionary spending, impacting savings and overall financial security. Higher mortgage costs contribute to increased financial stress, with many households allocating over 50% of their income to repayments. Reduced consumer spending, reducing growth in retail, dining, and entertainment sectors. Greater reliance on debt, as personal loans and credit cards fill financial gaps. This trend is particularly evident in Adelaide, where despite lower wages compared to Sydney and Melbourne, mortgage repayments for an average home still exceed 50% of household income. On one hand, interest rate fluctuations directly impact financial stability. According to the Reserve Bank of Australia, a 1% increase in the cash rate reduces household disposable income by 0.2% within a quarter. For households with variable rate mortgages, this means immediate financial pressure as repayments rise overnight. The shift back to variable rates in 2024 to 2025 has left many Australians vulnerable to higher borrowing costs. Key impacts include worsening mortgage stress, with repayments consuming an increasing portion of household income, declining consumer spending, slowing economic growth, and increasing business closures. Rising rental demand, as higher interest rates further lock people out of home ownership. While interest rate adjustments help control inflation, they worsen Australia's household debt crisis, making home ownership an even greater financial challenge. Australia's birth rate has declined significantly, falling to 1.5 births per woman, far below the replacement rate of 2.1. The cost of living crisis in housing plays a key role in this trend, forcing couples to choose between home ownership and starting a family. Many couples delay having children due to financial insecurity. Australian parents spend an average of $1,073 per month on child-related expenses, amounting to approximately $12,876 annually. These costs include housing, food, education, and childcare, with expenses rising for families with multiple children. Families opt for fewer children to manage mortgage and living costs. For many, the dream of owning a home and raising children is no longer financially viable. The increased burden of private debt forces many to prioritize homeownership, leading to long-term demographic and economic consequences. With fewer births and an aging population, Australia is at risk of long-term workforce shortages. The government has responded by increasing migration levels, which in turn drives up housing demand, further heating up affordability issues. Without intervention, the cycle of high debt, low disposable income, and declining fertility rates will continue to reshape Australia's economic future. Australia's housing crisis is not just an economic issue, it's a structural failure that is reshaping the country's financial future. Home ownership is slipping away from younger generations, private debt is climbing, and birth rates are declining as families struggle under financial strain. If this trajectory continues, Australia risks long-term economic stagnation and worsening inequality. The solution is clear: more housing supply, fairer lending policies, and decisive government intervention to curb speculative investment. Without meaningful change, future generations will inherit an economy built on financial insecurity rather than stability. The question remains, will policymakers rise to the challenge, or will Australians continue to bear the burden alone? Thanks for watching.